Happy Monday, everybody. Today is July 27th, 2026, and this is your Monday market update. And I hope you had a wonderful weekend. This could be one of the most consequential market weeks of the summer. We have a Federal Reserve meeting, important readings on inflation and economic growth, and approximately a third of the S&P 500 reporting earnings. Let's take a look at how last week unfolded. Stocks finished modestly lower on Monday as rising oil prices weighed on investment sentiment. The escalation between the United States and Iran raised concerns that higher energy prices could add to inflation and make the Fed's job more difficult. Technology and semiconductor stocks attempted to rebound, but the strength was not broad enough to lift the overall market. By the closing bell, the Dow was down about 0.5%, S&P was down about 0.25%, and the Nasdaq was essentially flat. Stocks rebounded on Tuesday as investors shifted their attention back towards corporate earnings. Earnings season has been encouraging so far, with approximately 27% of the S&P having reported. 86% of those companies exceeded revenue estimates, and 80% have beaten earnings estimates. And we'll see how that goes after this week. The market's advance reflected growing confidence that corporate profits remain resilient despite elevated interest rates, higher energy prices, and geopolitical uncertainty. The Dow finished up about 0.75%, S&P gained about 1%, and the Nasdaq rose about 1.25%. The market lost momentum on Wednesday as oil prices continued climbing. Investors prepared for a major round of earnings. Higher energy prices can raise costs for businesses and consumers while making it more difficult for inflation to return to the Fed's target. Investors also became more selective with valuations elevated. Companies were being judged not only whether they exceeded estimates, but also on spending, profit margins, and expectations for future growth. Makes sense. At the close, the Dow was essentially unchanged. The S&P was down about 0.25%, and the Nasdaq fell approximately 0.5%. Thursday brought the week's sharpest decline. Oil prices surged with Brent above $100 a barrel for the first time in many months, while the 10-year Treasury yield briefly rose around above 4.7%. Investors also reacted negatively to the first major technology earnings reports of the week. Concern was not demand that has suddenly weakened. The concern was that the enormous amount of money being invested in AI and whether those investments will ultimately generate sufficient profits and cash flow. Strong labor market data added to that pressure. Initial unemployment claims fell to their lowest level in decades, reinforcing the view that the economy remains strong, but giving that Federal Reserve little reason to lower interest rates. By the close, the Dow was down approximately 1%, S&P fell about 1.25%, the Nasdaq declined about 2.25%. Stocks did stabilize somewhat on Friday as oil prices retreated, as reports emerged about possible efforts to restart negotiations between the United States and Iran. Technology remained under pressure, but other parts of the markets held up better. The Dow finished the day up approximately 0.5%. S&P was essentially unchanged, and the Nasdaq fell about 0.75%. For the full week, all three major averages finished lower for the second consecutive week. The Dow declined roughly 0.5%. S&P fell a little more than 0.5%, and the Nasdaq lost just over 2%. Nasdaq's larger decline reflected renewed pressure on artificial intelligence and semiconductor-related stocks, while earnings have generally remained strong. Expectations are also extremely high. Simply exceeding expectations may not be enough when valuations are elevated. Investors have questions about spending and future returns. Under the surface, the market was not uniformly weak. Money moved away from some of the most expensive technology names and into areas such as materials, financials, healthcare, industrials, real estate, and consumer staples. This looked more like a rotation than a broad liquidation. Investors were not necessarily abandoning the market. They were becoming more selective and moving towards companies that are less dependent on aggressive growth assumptions. That distinction is important because the largest technology companies carry so much weight in the major indices. The S&P and the Nasdaq can decline even while many other stocks are holding up or moving higher. Investor sentiment has also become extremely bullish. That does not predict an imminent decline, but it does suggest expectations are elevated and the market could be more sensitive to disappointment. Looking ahead, this will be one of the busiest and most important weeks of the earnings season. Approximately 175 companies in the S&P 500, or roughly a third of the index, are scheduled to report. 4 of the largest and most influential companies will be especially important: Meta and Microsoft on Wednesday, followed by Amazon and Apple on Thursday. The importance of these earnings goes well beyond the performance of those 4 individual companies. Together, they represent trillions of dollars in market value and carry substantial weight in both the S&P and the Nasdaq. Their reports could influence the direction of the overall market. They should also help to answer broader questions about AI investment cycle. Investors want evidence that the enormous amount of money being spent on AI will eventually translate into sustainable earnings and cash flow. The Fed begins its 2-day meeting tomorrow and will announce its interest rate decision on Wednesday afternoon. The Fed's expected excuse me, to leave rates unchanged. So investors will focus on the language in its statement and Chair Kevin Warsh's press conference afterwards. The key question is whether higher oil prices, a tighter labor market, and resilient economic growth have made the Fed more concerned about inflation. Investors are going to listen for any indication that the Fed is becoming more open to raising rates later this year. Today's eco data includes preliminary durable goods orders, which will provide an early look at business investments and manufacturing demand. Tomorrow, we'll get trade balance, wholesale inventories, home prices reports, and consumer confidence. Thursday may be the most important economic data of the week. We will receive the first estimate of second quarter economic growth, along with personal income, consumer spending, weekly jobless claims, and the personal consumption expenditures price index, which is the Federal Reserve's preferred inflation measure. Friday brings employment cost index, which measures wage and benefit growth, along with consumer sentiment and long-term inflation expectations. Put that all together, investors will have an unusually large amount of new information by Friday. We'll hear from approximately a third of the S&P 500, including 4 of its largest companies. We'll also receive a Federal Reserve decision and important readings on growth, inflation, employment, wages, and consumer confidence, as if that's not enough. The central question is whether earnings and economic growth can support current market valuations without creating additional inflation. Strong earnings, moderating inflation, and steady economic growth would be constructive. Higher spending without a clear return, stubborn inflation, or a more hawkish Federal Reserve could create additional volatility. For long-term investors, the goal is not to predict every earnings reaction or every sentence from the Fed. It is to maintain an appropriate allocation, stay diversified, and keep decisions connected to your long-term goals rather than short-term headlines. Thanks for watching this as always, and we'll see you next week. Don't forget to check out Friday's video.